Well, hello and welcome to Moneycontrol. You've tuned into Earning Express. I'm your host, Nikki Mirchandani. Wipro has reported inline set of numbers, at least when it comes to the revenue, but bottom line seems to be a tad miss. In terms of margin performance, more or less in line with what the estimates were. Basic numbers first, just to give you a read-through of how the performance is stacked up. IT services revenue down by 1.6% sequential basis. The number has come in at 22,395 crore as compared to 22,755 crore. Moneycontrol was working with an estimate of a number of around 22,781 crore. That's a bit of miss. EBIT is also down sequentially by 1.3% at a number of around 3,606 crore. And the margins have come in at IT service margins have come in at 16.1% as compared to 16.05%. And the estimates were to an extent of 16.95% according to Moneycontrol poll. Talk about consolidated PAT put together, not just IT services. The consolidated PAT figure is down sequentially by 7.6% at 2,667 odd crore. Large deal bookings have reached in at $1.3 billion. Voluntary attrition rate continues to moderate sequentially, and the number stands at around 15.5%. And the sequential guidance essentially that you'd like to watch out for, that's coming at minus 3.5% to 1.5% in constant currency basis. Overall, the company in its press release has said that they expect revenue to be in the range of $2,617 million to $2,672 million. This translates into that guidance. Also, there are a few comments in terms of the press release, but we're going to talk about that later. Let's actually bring in our guest, Mayuresh Joshi from William O'Neill, who's going to be taking us through the numbers and his first reaction as to what he makes out of Wipro numbers.
Afternoon, Nikki. The numbers that you elucidated right now, obviously the top line degrowth that we probably seen is a little bit worse off than what the street consensus probably was. Street was of the belief anywhere between 0.8 to 1.1% decline sequentially in constant currency terms. That's a little worse off if I heard your numbers correct. The other element in terms of the margin performance, bang in line. I think the expectations were around 16.1%. But they've also taken a deferment of wage hikes. So wage hikes will happen in Q3, which means Q3 margins are definitely going to get impacted because of this scenario. And with the guidance that they've given in the quarter to come, the revenue degrowth guidance, which is a little worse off. I think the street was expecting degrowth to probably come through in Q3. And Q4 might also be a little bit soft because that is the quarter where a lot of decision-making processes happen. So I think with the degrowth in revenues, expectations in deterioration of margins because of the wage hike cycle that will be initiated in Q3, Q3 numbers will also be equally soft. TCVs largely in line, but I think what the commentary will tell us in terms of the business environment, consulting was always expected to be weak. Management should give some insights in terms of how they're looking at this vertical and what happens generally with the pricing environment as far as BFSI and high tech is concerned. So soft numbers for Wipro, a little softer than what was probably expected. And Q3, as I said, is expected to be even softer, which probably means that the stock might remain subdued and under pressure as far as numbers are concerned.
All right. What do you make out of the large deal total contract value, which has reached to a number of $1.3 billion, which is the highest in last 9 quarters that we have? How does that compare to rest of the peers, which perhaps have recorded in a smart number, a record high number? How would you look at that?
So the number is better, but I think the larger ones, which have reported numbers like an Infosys in excess of $5.5 billion, TCS in excess of $10 billion. So obviously what Wipro has reported in terms of the total contract value or TCVs is a tad better than what the street was probably anticipating. But there is no great expectations of a significant deal win announcement that might be there going forward. I think the game changer for Wipro is obviously going to be consistency in deal wins that they probably acquire, the expectations in terms of more stable revenue growth, both in CC and dollar terms, and far more and a far more belief in terms of consistency when it comes to their core IT services segment, both from a standalone revenue perspective and a margin perspective. I think Wipro
Great.
is lagging on most factors when it comes to pure comparison with the larger peers.
Point well made, lagging the peers as compared to the estimates. But I'm going to bring across Harpriya Suresh, who is the senior correspondent in the IT startup team for Moneycontrol. Evening there, Harpriya, what are you making out of the numbers? What stands out for you?
Right now, I mean, the numbers show no surprises at all. I think Wipro's quarter was expected to be soft. The revenues are in line. PAT has missed estimates. The TCV is decent considering the fact that Wipro has not announced any large deals so far this quarter as compared to its peers. I mean, a headcount decline was expected. The revenue decline was expected as well. So I don't think there's any surprises. And now I think the focus will be on the commentary to see, one, what are they going to do about the softness in BFSI and how it's affecting them? And secondly, what about consulting, given the fact that softness was expected in consulting because of the slowdown in discretionary spending and the fact that Wipro has spent a considerable amount in acquiring companies like Capco and Rising in this space.
All right. Harpriya, in terms of guidance, what do you make out of it? Was it in line with what you were estimating or the Moneycontrol estimates were? How are you looking at it?
Guidance was lower than what we had. It was lower. It missed estimates because they have guided for a decline of 3.5% to 1.5%. But the estimate was that it would be around -2% to 1%. So guidance is definitely on the lower end. But I mean, I think across this quarter, across companies, we've seen sort of a decline or a slashing of guidance in some sense. Wipro does give sequential guidance, but this was worse than what we'd expected.
All right, Harpriya, we are just going to leave it at that. And thank you for taking out the time and joining us this evening. But we are going to go across to our third guest, Prakash Diwan, who is the market expert joining us and talking about his first reaction on Wipro's numbers. Evening there, what stands out for you in the fine print? What do you make out of the guidance and is it disappointing?
Okay, so let me take each of these three questions separately. The first thing that seems promising, as is the case with some of the other bigger names, is the TCV. That's much better than what I think most people were expecting. The challenge for the company lies in the fact that after almost 2020, they've seen a revenue degrowth. So what has changed for them? And I think this is the price the company is paying for all those exits that they've seen at the top management. A lot of the key management personnel have moved out in the last 6 months, and that's probably beginning to impact. So when you see that revenue sluggishness, when you see the profit dip, which means that they're not able to get revenues at decent pricing. So that's impacting the profit more than the revenue miss. And going forward, Nikki, what's important is, of course, the guidance, the commentary will explain a lot of those things. But going forward, you have a lot of furloughs, a lot of lesser number of days to execute projects in the current quarter. So if that is the case, they will have to kind of lower the guidance, or probably they will not be able to promise any kind of an improvement. So sequentially, it's fine, but even on a YOY basis, things look very different for them. So not something very impressive, but that's the case with most companies. Some of them have had good quarters, but they are warning about or cautioning about the subsequent quarters. In Wipro's case, probably even the quarter gone by has been too sluggish. So the market probably doesn't expect fireworks from here on as well. It's going to be a very range-bound, very kind of a performance that you could expect.
Sure, Prakash. One more thing that I wanted to ask you essentially, and also come back to Mayuresh after that. Essentially, there is also restructuring which is taking place. Let's just say an amalgamation of 5 subsidiaries into one. Wipro HR Services, Wipro Overseas IT Services, Technology, Trademark, OLSI. And the rationale that they've given as per the press release is perhaps to ensure optimized legal entity structure, enable synergies of operation, reduction in overheads, and significantly reduce multiplicity of legal and regulatory compliance. How do you read into it, Prakash, first, and then we'll come back to Mayuresh in that case?
No, I think this is certainly a welcome step, and it's certainly work in progress, because what's happening is you need specialization to be put into different entities when the business is growing at a rapid clip. But when the reverse happens, you would have to consolidate, make sure that overlaps are removed, multiplicity is removed, and you bring your profitability back in. So that's what they're trying to do. How long does it take? As I said, the next quarter, the current quarter, December ending, might not yield great results. So whatever happens is going to be post that. Remember, Nikki, one thing we need to remember, Wipro has a huge consulting DNA, which it has always come in, and the acquisitions they have made are also in that nature. So IT services are not necessarily something which they can grow very rapidly, even if the situation changes. So they will have to re-engineer themselves, and that's probably what they're doing by announcing this consolidation move. So look forward to that. But all of that's going to be in the near term to the medium term. Nothing's going to be immediate or short term.
All right, Mayuresh, coming back to you, thank you for waiting by. Please let us know what is your view about this. How do you read into the restructuring part or just the merger of 5 into 1? How are you reading into it?
In my opinion, I think it's not going to make a significant accretion as far as the overall numbers are concerned. Because I think the core focus areas for Wipro, specifically the consulting business, Capco and Rising, I think how are these businesses shaping up along with high-tech and BFSI are going to be extremely critical for the kind of growth that we probably expect. The other element also is their positioning in the cost-cutting elements and the vendor consolidation. I think Wipro has been extremely weak in that, Nikki. And if they have to reach Joe's margin targets of 17%, what are those margin levers that Wipro is probably looking at in terms of creating that impetus that will lead to significant EBITDA expansion going forward? So I think there are a lot of questions that need to be answered. Senior exits are not making it easy as well. And therefore, I think a lot more to be answered by Wipro on the table as far as numbers and the overall execution is concerned.
Sure, clearly that's the word coming in terms of key monitorables. Gentlemen, thank you so much for taking out the time and joining us. Of course, we're going to be cutting into the presser in just a jiffy. Monitorables ahead of the presser, TCV deal, the deal pipeline, along with the commentary surrounding the deal pipeline and the demand and the way it's stacking up. Q3 FY24, of course, the guidance and the next quarter guidance, which has already been given, and the margin levers that most of these guys actually spoke about. We're going to be talking about that and perhaps hearing about that from the presser in just a jiffy. But tune into it for more.
Iyer and our CHRO, Saurabh Govil. As usual, our CEO will kick things off with brief remarks about our earnings this second quarter, and then our CFO will provide a detailed financial overview. This quarter, you will also get to hear from our COO about an update with our business transformation plans. So with that, let me pass the mic over to our CEO, Thierry Delaporte.
Thank you, Sanuba. All right. Good afternoon, everybody. Thank you for joining our second quarter earnings press conference here in Bangalore. My executive team and I are, as always, glad to have you here. I'd also like to welcome Aparna, our new CFO. Aparna, great to have you here with us for your first earnings press conference. So, I'll begin today's conference with an overview of this quarter's results, details of our sectoral performance, the demand environment for sure, and the directions for the coming quarter. Q2 was yet another quarter of strong deal bookings. In total contract value terms, we closed large deals to the tune of $1.3 billion. This is the highest in the last 9 quarters. And this represents a 79% year-on-year growth and a 6% growth on a quarter-on-quarter basis. We booked as many as 14 deals in the greater than $30 million TCV range versus 10 in the previous quarter. Total bookings from a TCV standpoint stand at $3.8 billion, which is a growth of 6% year-on-year. We added one new account in the greater than $100 million client category in Q2. We now have 22 accounts in that bucket. If you remember, we had 11 $100 million accounts in FY21. So we've doubled the number of accounts in the $100 million category. We have also won two close to $500 million deals in two of our large accounts. As has been the case for several quarters now, cash flow also has remained strong, but 145% of net income in Q2. EBIT, or earnings before tax and interest, of our IT services segment has increased 6% year on year. So it gives us great confidence that we are winning in the market against the backdrop of economic weakness. The business environment, as you all know, has been uncertain. Inflation has stayed high, as have interest rates. Clients are continuing to take a much more rigorous look at their investments. That is clear. They are hyper-focused on efficiency, on optimization of existing investments, and faster return on new ones. So, lower discretionary spending is a reality today. Conversion of order book has become slower. Transformation programs that are nearing their project terms are being replaced by new ones, but at a slower pace. All of this has impacted our top line growth as well. In Q2, revenue declined 2% quarter on quarter in constant currency terms. But even though there's some softness in top line growth, we are continuing to hold margin steady. Operating margin for the first half of fiscal year 24 was 16.1%. This is 110 basis points higher than our operating margin in the first half of fiscal year 23. Now let's look at our strategic market unit, our four strategic market unit. In our Americas 1 market unit, revenues grew 1% quarter on quarter in constant currency terms in Q2. This revenue growth was led by strong performance in our healthcare business, as well as in the technology, the products and platforms business. Order bookings, in terms of total contract value terms, grew 36% year on year. Our Americas 2 market has higher exposure to consulting clients, as you know, and to the BFSI sector. So we saw a higher than usual impact of the macroeconomic slowdown. Revenues in our Americas 2 market declined 2.3% quarter on quarter in Q2. Europe has been a growth engine for the last 2 years, you know that, growing by 39% in FY22 and 12% in FY23. But slowing demand and reprioritization of client spends has weighed on our European business. As a result, revenues in this market declined 5% quarter on quarter. But we are seeing strong traction on the order booking side, which in total contract value terms increased 10% in Q2 year on year. So given our strong bookings in this market, we are confident of a swift rebound. Finally, in our APMEA market, revenues for the quarter declined 0.5% quarter over quarter. Our goal in this region is to capture the rapidly digitizing market. We are leveraging our global scale and domain expertise to continue to move our portfolio towards higher value transformation projects. This focus on improving the quality of revenue is now clearly reflecting in our margin performance, which has improved 330 basis points over the last 5 quarters. being able to sustain margins despite softer revenues is largely due to our ongoing transformation efforts. This includes several programs around delivery excellence and operational efficiencies. Across the board, we are pivoting our business towards high quality, high potential businesses and reducing our loss-making accounts. We are working on faster bench deployment. In the last quarter, utilization increased to 84.5%, an improvement of 80 basis points quarter over quarter. Our account segmentation strategy, together with a One Wipro approach, is definitely helping us seal bigger deals with existing clients and win in a consolidating market. And I'm proud that we are seeing these benefits within 3 months of moving to the new 4 global business line operating model. Amit will share more details shortly. Both on the delivery assurance and efficiency side, these actions are having an immediate positive impact, while also setting us up for long-term margin resilience. Because profitable and sustainable growth is our top priority. In Europe, we closed 3 large consolidation deals in Q2 at a 100% bid to win rate. Example, a global bank has selected Wipro as its partner to deliver multi-year digital transformation initiatives. For that, Wipro will work with the bank to build bespoke solutions to enhance its global products and services through responsible use of AI and hyper-automation. This will deliver superior customer experience, better use of data, better use of analytics, and drive significant operational efficiency. Our partnership strategy continues to stay strong as well. Bookings through our partners as a percentage of total bookings have continued to increase from 25% in fiscal year 20 to 44% in FY23. And actually this quarter it was at 53%, so 10% more. What are we seeing? Increasingly, clients are not just looking to migrate to the cloud, but also run and grow their businesses more efficiently on the cloud. Our full stride cloud services is setting us apart from competition and letting us tap into opportunities across the cloud journey. For example, a multinational healthcare and insurance firm wants us to co-create their consumer and digital experiences. As a strategic technology partner, we will build AI and automation solutions to drive speed to market, better client experience, and of course, reduce their cost. Our high-performance software engineering program will bring them at least 20% efficiency. Overall, this engagement will strengthen the client's workforce management strategy and expedite our tech rollouts. Now, if you look at the bigger picture in this, what you'll see is that our ongoing transformation is driving a substantial improvement in our market position. And that's, in turn, reflected in the types of deals we are winning as well. Clients now look to us to help them solution and orchestrate their transformation. They trust us with their complex challenges. That's reflecting in the latest customer satisfaction survey as well, with our NPS, Net Promoter Score, expanding by 840 basis points, which is very significant. I'll take a few minutes now to share an update on Wipro's AI 360 strategy. Since our announcement last quarter, we have trained 180,000 employees in basic Gen AI principles. We have rolled out persona-based learning pathways to create a pool of specialized talent with deeper technical expertise. We are working with our alliance partners to further enhance AI learning pathways through our AI and cloud academies. Recently, we launched a new Gen AI Center of Excellence with IIT Delhi. We are very rapidly integrating Gen AI into our processes, our solutions, our offerings. Thousands of our employees have or are starting to use Gen AI. In the HR function, for example, our teams are seeing significant productivity gains by using Gen AI for candidate background verification. Then, in marketing, we're using Gen AI for content generation and translation. Tasks that used to take hours earlier now takes minutes. In sales, we're implementing Gen AI to do market research, improve sales collaboration, but also generate RFI responses. In our engineering business, Gen AI is helping with software development and lifecycle automation. One of the areas with the biggest productivity gain is in quality engineering and in quality assurance testing. Gen AI is helping with scenario creation, code generation, synthetic data creation, as well as execution at scale. Initial pilots of these Gen AI apps have been so successful that we are now rolling them out to all our employees. On the client front, Gen AI is now a part of every client conversation. There's tremendous interest in exploring new use cases, as well as understanding the benefits and the implications of this technology. Imagine the number of Gen AI active projects have doubled than just 1 quarter ago. For now, we are seeing rapid adoption in healthcare, in consumer, in financial services, and I would say with high-tech and utilities following closely. One example I can share with you here is we are working with a US-based health insurer to deploy a Gen AI-based chatbot for their agents. We're developing a solution that is fine-tuned to be more contextual, so that agents can provide more personalized assistance. The solution is driving 30 to 40% reduction in operations cost, significant improvements in agent productivity, of course, and therefore improving net promoter scores. Another example. We are working with a European multinational telecom company to unlock value from data. Working with different vendor tools and software kits, we are generating high-quality synthetic data, which allows the client to increase cross-border collaboration, mitigate bias, and eliminate distribution limitations that exist in real data. As the technology evolves and Gen AI output becomes more accurate, we expect demand for our Gen AI services and expertise to increase greatly over the next 6 to 12 months. Frankly, we're very excited by the opportunities Gen AI presents, and we're investing in new use cases, solutioning for clients, as well as upskilling our employees, because we want to take a leadership position in this space. A word here on our guidance now. For the next quarter, we're guiding for a sequential growth of -3.5% to -1.5% in constant currency terms. We expect margins to stay range-bound, as we've seen over the last few quarters. As the markets start to turn around, on the back of our transformation and efficiency plays, we expect to start seeing improvements in the coming quarters. Despite the global slowdown, Wipro will continue to invest in its people through training opportunities, leadership development, global exposure to new clients and technologies, and by rewarding them with merit-based salary increases. Wipro's intellectual capital, our people, are definitely our biggest strengths. We're continuing to strengthen our foundation, streamline our operations, and moving towards a more modern, dynamic culture. We have the right strategy, vision to keep us competitive and resilient. With that, I'll turn it over to Aparna for her comments. Thank you.
A very, very good evening to everyone joining us today. In my update, I will cover some key financial highlights for our performance during the quarter. Our IT services revenue for Q2 decreased 2% quarter on quarter in constant currency terms, which was at the lower end of our guided range for the quarter. We are happy to report another quarter of healthy deal bookings. In total contract value terms, we closed large deals to the tune of $1.3 billion, which is a 79% year-on-year growth. We also booked 14 deals with greater than $30 million of TCV range. Total bookings from a TCV standpoint stands at $3.8 billion, which grew 6% year-on-year. Turning to margins. Our ongoing focus on operational improvement has ensured that our margins remain steady even in a softening revenue environment. Our operating margins for the second quarter was 16.1%, which is an expansion of 100 basis points year-on-year. Shifting to our cash flow performance for the quarter, our operating cash flow for Q2 was rupees 38.6 billion, which was 145% of our net income. Our free cash flow as a percentage of net income was 149%. Cash conversion has been strong even in the first half at 137% of our net income. At the end of Q2, we had $4.1 billion of gross cash and $2.2 billion of net cash on the balance sheet. Now let me share certain other important details relating to the financial performance. Net income attributable to shareholders for the quarter was at INR 26.5 billion rupees. Our EPS grew 4.1% on a year-on-year basis. Our effective tax rate remained flat during the quarter at 24%. On the forex front, we realized our dollar-rupee realizations in IT services for Q1 was at rupees 82.54. Our DSO for the quarter at 79 showed an improvement of 3 days year-on-year. Over to the guidance for the next quarter. Our guidance outlook for the IT services business segment is to be in the range of 2.617 billion to 2.672 billion. This translates to a sequential guidance of -3.5% to -1.5% in constant currency terms. Thank you, and over to Amit.
Hello everyone. I'll share some updates on our business transformation and how it's reflecting in our steady margin performance. Our new 4 global business line model has allowed us to deliver a one Wipro service excellence approach to our clients. It is reflected in our latest customer satisfaction survey, with our NPS expanding over 840 basis points. This directly reflects our performance with the clients, delivery, program governance, and our capabilities that is setting us up for further strengthening our delivery-led sales. On the delivery excellence side, we have been very focused on consistent, efficient, and productivity improvements for our clients. Automation and Gen AI is our cornerstone here, with the corresponding productivity kicking in both on delivery and functional sides. Over the last quarter, on our operational efficiency front, utilization is now at 84.5%. In fact, utilization has increased by almost 470 basis points in the last 4 quarters, including utilization of our next-gen associates. We have taken several actions here, from sustained bench reduction to pyramid optimization, to onshore-offshore rationalization, and rigor around our subcontracting costs. Alongside, we are keeping a close eye on discretionary spends with increased rigor on cost and efficiency management. Thierry has talked about skill being our biggest currency. On the talent reskilling side, we continue to scale Gen AI talent. As you heard, over 180,000 of our employees have taken the first level Gen AI course. Focused upskilling initiatives across skill families are in place now, including several account academies. These are collaborative initiatives with our clients. They're providing us a skilling roadmap for our teams to serve them better. I'm pleased with the progress that we have made so far, and a lot more lies ahead. Now, I turn it over back to Sanubra.
We're now going to start the Q&A. If you have a question, please raise your hand and wait for the microphone to be passed on to you. We ask that you please introduce yourselves before you ask your question, and please try to limit your questions to one so everyone can get a chance to speak to our executives. Thank you.
Hi, I'm Ritu Singh from CNBC TV 18. The first question is on your constant currency revenue growth. For 3 quarters now, we've seen a decline. And your guidance for the next quarter as well also shows a negative growth of 3.5% to -1.5%. While your peers are also talking about this slowdown in the discretionary spend, why such a drastic reduction in, sort of guidance? It's much below what the street had also factored in. Where are you seeing this weakness apart from, the larger markets that you've highlighted? And when is that turnaround that you're talking about going to start to materialize? And if you can add a word on the margin levers as well that you're using to get to that aspirational level of 17%. And one question for Saurabh as well. There's been a decline in the headcount, which has continued, I think, for the last 4 or 5 quarters now. Any hiring plans for the year, or, given that we're getting into the December season, will you stay away from campuses for the year?
Okay, all right. So let me respond to the first part of the question. For several years, we've had a market of growth where, we've been able to grow quite significantly. Over the last few quarters, what have we seen? And I think I'm reflecting for the industry. What we have seen is that, on one hand, there's a good volume of business, and on the other hand, there is a significant reduction of discretionary spend from clients. Bottom line is there is not the same level of growth in the market that what we had before. For us, it's a fact. We are not growing. You said it, definitely. And that's, a reality. But what's key for us is to make the right investment, make the right decisions now to make sure that when the market picks up again, we are ready. So it's about, making the right investments. It's about, working on our efficiency model, what Amit described. It's about continuing to invest in larger deals, win those large deals. You've seen this is the best quarters we've had in terms of large deals, and I think it's an encouragement on the fact that we continue to get better quarter after quarter on winning those large deals. So, and then, the work on the margin, what is clear is that, despite a market where there is no growth, we are doing what's required to maintain our level of margins to the place that we've, delivered on for the last quarters through, efficiency program, working on how agile we are. We've made an organizational adjustment 3 months ago with the creation of 4 GBLs. Just allows us to be more agile, more nimble. We also continue to invest in our account strategy. And I think it's very, very important. When the market will pick up again, this will pay off. Saurabh?
So hiring, it's a function of, our current supply chain in terms of the demand we have, the bench we have. Amit spoke about the utilization improvement. So we will continue to hire and be hiring every quarter. From a campuses standpoint, which you want to know, our first is to make sure we honor every offer we have made to our people. And there are still some people left to be honored. So we'll be doing that before we go to the campuses. So, and that's our intent, and we will see much more better view of the thing as the market looks up. But right now, we are very focused on making sure we honor all the commitments we have made in the past.
These commitments that are yet to be honored, that you said, out of the total?
No, the numbers are ongoing. Every quarter, we are onboarding people. So, I don't know the exact number of people, but what we had made last time, which we had said that there are people who have yet to be onboarded, we are going to continue to onboard them right now. First, that will be the priority for us. Thank you.
Hi, Haripriya from Moneycontrol. One, I wanted to understand, you're rolling out your wage hikes are this quarter, and you've maintained that your margins aspiration is 17%. But do you expect an impact in Q3 because of the fact that you're rolling out the hikes? Are you seeing any cancellations or ramp downs? I mean, you talked about delays and closures, but are you seeing other impacts as well? Because you're saying that your large deal TCV is the highest in 9 quarters, but your revenues continue to decline. I just want to understand the dichotomy over there. And wanted to get a sense of the variable pay for the quarter. That's it.
Of the?
Variable pay for the quarter.
Do you want to take the variable pay?
So variable pay for the quarter will be in line with what we had done last quarter. They'll be different for different units based on their performance. But approximately around 80% is what people will be getting.
Yeah. So you want to talk about the margin?
So we don't guide for margins, like Thierry said. Yeah, so like Thierry said, we are likely to remain range bound in terms of, the margins that we've delivered over the last few quarters. There are headwinds, you spoke about them. Our guidance reflects a weak revenue environment. There are also furloughs, and we are making investments in people. So it is a challenging task, but we have several initiatives in place that Amit spoke about. We have enough levers as we look forward, including fixed price productivity, in terms of even using AI. It's a huge opportunity. There are pyramid improvements. There is work that has been initiated on, in terms of, of course, the continuous rigor on, the discretionary spend cuts. So those are things that we are looking ahead, and there are enough levers for improving margins as we go.
This is honestly, I sorry, I forgot that point. So I can go back to what I was saying about a quarter ago, because this is more or less what we are seeing. And, I'm not hearing anything different from my colleagues. I believe that, what's happening at the moment is there is a demand in the market. We are seeing deals. Our pipeline is actually very healthy. And, the level of bookings, TCV, has been pretty strong for us. But there are, ramp downs, there are reduction of discretionary spend. We see that. Consulting business is more exposed today. We know that, and will be the first one to rebound. I think it's, that's what we continue to observe. I don't have in mind any termination or any. So it's just a lot of this discretionary spend that have been put on hold, in particular in BFSI, in consumer communication, and in technology.
Hi, Thierry. Chandra Shrikant here, Moneycontrol. You mentioned that your TCV is the highest in 9 quarters. If you can give us a sense of what percentage are renewals, how much of this is net new deals, and why isn't this translating to revenue growth?
Okay.
Question 1. Question 2, analysts are also concerned about the senior management attrition at Wipro. I think you've had, 9 top-level exits this year, including Jatin. So why are things not settling, despite putting a new structure in place? How are you planning to address that?
Chandra, let me, so I'll take the 2 points. I'll start with the second one, which is the senior attrition. 3 years ago, when we designed our strategy for Wipro, we have laid out a significant transformation of our organization, right? Redefining our ambition, resetting our go-to-market strategy, defining key strategic markets, investing in talent, and so on. To drive this transformation, it was very clear to us that we needed to bring talent from, multiple places. The value of driving more diversity in the organization was required to drive this transformation. And that is what we've driven for the last years. I'm very happy with where we are. We have a great team. We have leaders in the key roles to drive, the agenda. You mentioned Jatin. So Jatin has been our CFO for many years, as you know. He has made a decision. In a way, I would tell you, I'm also proud for Wipro that we are, our talent are, being looked for in the industry. I wish him the best. And I'm very glad to have Aparna. She's doing fabulous. She did a fabulous start. And that's the strength of the leadership of Wipro. We have the next generation of leaders for this organization. So that's on the point number 2. Okay. And I'm not absolutely do not feel in a context of instability of leadership at all, honestly. On the point number 1, which is the dichotomy between, the volume of deals and the revenue. Again, I don't think we are the only one seeing that phenomenon, which is that, there are quite a bit of large deals. Clients are looking at ways to drive larger program to reduce, in particular, to drive cost out. And we are winning in a lot of these deals. So this is good. But, the typical pyramid of, large and smaller deals has evolved. There's a lot less of those very, very small, what we call the discretionary spend, which typically is not translating into a very, very large deal, but many, many smaller, has reduced. And so I understand your question, but this is very rational. In fact, yes, we have great volume of large deals. We actually continue to increase our backlog of committed revenue for next year, which gives us a lot of confidence because we know that discretionary spend will resume. And by the time it will resume, we'll be ready to start, at full speed. Make sense?
Sir, hi. Varun from Mint. Just a follow-up to what Chandra had asked. Can you please tell us what is the net new deals from...
Right. So, Varun, we are not disclosing this number, but I would tell you, because we are tracking it and we are looking at it, there's a good balance. This is basically, and even when, so it mostly coming with existing account, but new piece of business, new stream of revenues.
So here
so this, what happens, Varun, sometimes is you might have a component and then you have an extension, which is including a bigger portfolio, a bigger perimeter. That's what we are seeing.
So here is where your TCV number appears to be misleading. And pardon me for asking that. Because if we look back year over year, of course, your revenue base has grown. And so the TCV, which includes renewables and net new deals, will also increase. But if I have to look at your other metric, that is the number of new customers, which has fallen at or rather has halved, which is a pretty scary number.
No.
Which tells us that perhaps Wipro's sales engine is not active what it used to be about 12 or 18 months back. Because if I look into just the last observation, your revenue, quarterly revenue after December would be almost the same what it was October, December of 2021. So you are actually going back 2 years back for your quarterly revenue. So the macroeconomic hasn't really turned that bad, where Wipro is actually going back with regards to new deal wins or with regards to your quarterly revenue. Thank you.
Varun, thank you for the question. So let me respond to that. First, the number of clients. I was impatient to respond to your point because it is our strategy. We want to reduce the number of the very, very small clients. It has always been our strategy to focus on our larger accounts and grow them. And that's how we've been able to double the number of $100 million accounts. So for sure, if you look at the number of accounts, Wipro used to have many very, very, very small accounts. And the cost of investment to grow these accounts was, not productive. So our strategy is to focus on large accounts, and that's what we are doing. So no wonder that you see this pattern. It's on purpose. On the revenue growth, we've been, if you look back over the last, if I take as a point of reference 2020, when I joined, we've grown north of 40%. For the last 3 quarters, indeed, we are in a different market. And that's a fact. I think we are, you see the same patterns in this industry today. What's key in such a market for us is to make sure that when the market rebounds, we are ready. And so, very important for Wipro to keep focus on the key elements of its transformation, to make us more agile, to be able to, increase the margin as we mentioned, midterm. And that is clearly what we are doing at the moment.
Thierry, hi, Beena here from Economic Times. Just an extension to that, by when do you see the deals translating into actual business? Can you be more specific in terms of, which quarter do you see that coming?
Yeah.
And secondly, what is the purpose of the merger of the units, just to get a sense on...
The merger of?
Of the 5 units which has been announced today.
Oh, legal entities. Sorry. Okay. You want to take that one, the legal entity, or this is a technical? It's a technical merger. It has nothing to do with business.
Yeah.
Nothing beyond that.
Yeah. Nothing beyond
that. It is not impacting the operations whatsoever. It is a legal optimization.
Administrative convenience. This has nothing to do with the business.
The first point was on outlook, right? Considering the market conditions stay more or less the same, we will see a rebound in the next few quarters. I cannot tell you more. We are not guiding beyond the given quarter, but that's the feeling we have.
How do the next 2 quarters specifically look in terms of translation of these?
I just said.
Next 2 quarters specifically, because you said you expect a rebound.
You've got my guidance for next quarter, for coming quarter.
Okay, thank you.
So I'm Akanksha from Business Today. I wanted to understand what's your outlook for your consulting business, especially after your restructuring exercise. the market hasn't really been good for the consulting business. How do you think it's going to react in the next view?
You know, the market continued to be difficult for the consulting business. And as you know, especially in BFSI sector, right, which is a market where discretionary spend has been, significantly reduced. This will come back. I've always seen that. This market is very healthy, is well positioned. I mean, this market, these operations are very healthy, well positioned. They'll bounce back as soon as, the volume of discretionary comes back.
Could you also share some plans about your AI 360 policy? I mean, you've already upskilled a significant part of your workforce. You also have a center of excellence. Any other plans for the upcoming quarters?
There's not one single management meeting in Wipro where we're not talking about AI 360, our program where we are massively investing, but also transforming ourselves. Imagine 180,000 people trained on Gen AI in 3 months. And we continue. It's only, the first step. We're going to inject AI into every single solution offerings in the next 6 months. We are injecting AI into every of our processes internally. All my colleagues here have their own AI and Gen AI agenda for the coming weeks and months. So we see it as an exciting opportunity for Wipro. We feel we are well positioned. We have a lot of engagement with clients. Still not huge in size. But when you look at the number of these active engagement, it has doubled just in 3 months. This is not usual, right? It shows that it is a reality. And that we are on top of it. So we'll continue to update you. Again, we have a lot to say. We have an ecosystem of 55,000 people that train on AI in this organization that are professionals in AI. This is, quite an exciting development for Wipro.
You had promised a significant investment in AI as well. Seeing the interest by clients, are you going to increase it?
And that for sure, I can tell you, yes, given the current market outlook, we are working on rationalization, on productivity measure, and Amit talked about it, but the investments on AI are committed and will not be slowed down, that's for sure.
We'll take one last question before we wrap.
Hi everyone, Rishabh here from Informist. On your manufacturing verticals, it was doing quite well for a large period of time, longer period. So what happened there? Can you give an explanation?
I think the manufacturing sector continues to do well for us. We have seen 1 or 2 projects that were slowed down in some of our accounts, but nothing that is structural. So, this will continue to do well. Our engineering business is doing well in manufacturing. We have, a good volume of portfolio. The pipeline is good, so it will bounce back.
Ladies and gentlemen, that concludes our second quarter fiscal 24 earnings conference. If you have any additional questions, please do not hesitate to reach out to our media relations team. We'd be happy to assist you. Thank you so much for joining us today, and we'll see you again next quarter.
Thank you, everyone.